FHFA announced the new conforming limits for 2023 today on Real Estate Daily. Welcome everyone to Real Estate Daily, or RED. My name is Troy, and every day we go over the latest news in real estate, housing, and the mortgage markets. Well, today I have a couple of articles I want to go over, but the most important is, what are the new FHFA or conventional loan limits? Now, I have a huge opinion on it. It's kind of crazy in my mind, but we're going to go over that today. But before we jump into all of it, do me a favor, hit that subscribe button. Boom, boom, boom. We want to get as many people out there. We want to explain what's going on in the housing market. There's so much confusion going on out there. I see it every day. I see positive articles. I see negative articles talking about the exact same data, which is kind of crazy. So let's jump into it. Last week, FHFA announced conforming loan limit values for 2023. Now, we moved up the loan limit. We increased the loan limit to $726,200. Now, this loan limit is for the higher end counties across the United States. In California, it almost applies to everything here. Now, what I felt was, everyone out there is complaining about how much the loans are right now. So what we typically see is that if you are a conventional loan and you're going up against other people, you go to your loan limit a lot of times, especially in housing in that range. Before it was like 650 and you were like, okay, I can't go over 650. I can only afford 5% down. I'm going to go up to that point. Anyone that was able to put more money down or qualify for high balance or jumbo loans, then they would get those homes, but a lot of buyers would go up to the loan limit. Now, when you raise the loan limit $90,000, let me go over this. This is or $79,000. It says, in most United States in 2023, the CCL value for one unit properties will be $726,200, an increase of $79,000 over $647,200. Guys, this is crazy to me. If you want to see a housing market cool down, this is not the way to do it. This is going to allow people that can only afford up to just the conventional loan limit now to exceed it by $79,000. This is crazy in my eyes. If you're looking at a downturn in housing, why would you even do this? Why not keep the loan limits the same from one year to the next? There isn't, what is this, 10%? This is what, 12, 14% higher? Why would we go like those crazy numbers? We're not seeing year over year increases in home values across the United States. And then how many counties do you even see that would even qualify for this? Maybe East Coast, some West Coast. I just don't get it. I don't understand what they're thinking here. They're just going to go and allow people to, in Fannie and Freddie, allow people to actually, extend the value of properties even higher. Now, that's just one thing. Here's the next one that I thought was kind of crazy as well. It says the new ceiling loan limit for one unit properties is $1,089,300. Are you kidding me? It's 150% of $726,000. Guys, we're going just absolutely berserk. Now, here in Orange County, that might make a little more sense, but wouldn't you want to have people that put more money down, not people to put less money down and then get up to close to 1.1 million? I don't understand what's happening here to the FHFA. I think they've just gone crazy, or are they setting people up for, bad loans? If we look at it, we also saw that came out today. And I don't really subscribe to some of these things, but I think it was in another article that 8% of all loans that were originated this year, 2022, have now gone underwater. Now, 8% isn't very much, and underwater just means that, I have less equity in my house. I have no equity in my house, basically, and I own a mortgage, but people don't look at it that way. Most people who have negative equity or don't have as much equity, they're not looking on a daily basis or a monthly basis on what their home is worth. They're just they're considering, or I should say they're focusing on making the payment every month. We know that there's 10-year cycles typically in real estate, and that within 10 years you're going to see an uptick. 2008, the actual slaughter fest of 2008, 2009 housing turn, when it went down, that the crisis in the housing market, we knew that in 10 years, we knew that all the values of the properties on that downturn had all, for pretty much most all, exceeded that amount. So when we're looking at these things, I just don't know why the government is allowing Fannie and Freddie to press up higher and higher. It doesn't make any sense. I mean, I think there's going to be just some failure here to some people to extend themselves, especially when you have the Fed trying to crush jobs. And the jobs they're crushing isn't these, minimum wage, worker jobs, flipping burgers, and they're not looking at crushing those jobs. They're looking at crushing Silicon Valley jobs. They're looking to crush the 100,000+ jobs. Those are the people that are real spenders. Anyone that's working at fast food restaurants isn't going out and putting $5,000 a month into crypto, right? Or isn't going to go and put it in equities. Those aren't the people. They want to slow the people that are making $100,000+ down. That's who they really want to affect. And they are affecting them, as we're seeing tens of thousands of jobs being laid off. But, raising this doesn't make any sense to me. I'm not sure what they're thinking, but that's just my opinion. We will go into this as time goes on and we get closer and closer to the end of the year. Now, next article. Now, the things that I've been saying now for about 6 to 8 months, this is not financial advice. It's never financial advice, by the way, is that if you look at 401ks or retirement funds out there, a lot of them taking kind of a beating this year. And I've said, a lot more people should be looking at self-directed IRAs. That means you're in control of your retirement funds, not some Joe Schmo in Wall Street who's making 15% or 20% off your profits, has no risk involved, just takes your money and does what he wants with it. Well, we're seeing now that when we get to a point where people are withdrawing their money off of these 401ks, we're seeing that when it's all said and done, they don't want to, these retirement funds like Blackstone doesn't want to run on it. Well, Blackstone limits withdrawals from real estate fund as inflows slow. Inflows aren't slowing. Outflows are blowing up. And every quarter, they only want to see 5% of their fund on an outflow. Otherwise, they hit the brakes and stop outflows. So they take your money, they invest it to whatever they wanted to invest. And when you want it back, they say, no, hold on. You can't, or you can only take partial withdrawals. You got to listen to us. You have to deal with us. Guys, I would be on the fence and I would start looking to self-directed IRAs. There is no way that I'm going to have some company come out here and tell me that I can invest in them, but I can't take my money out. Or I can only take out a small percentage of my money. That is ridiculous. And that's exactly what Blackstone is doing right here. In fact, if you see this story, it says Barclays downgrades Blackstone to equal weight following Blackstone Real Estate Investment Trust limit. Yes, of course. Two things that are happening here. One is that real estate values are floating down. Number two, they are now, and let's go hit the next one, they're now using some of the money on BlackRock, right, is for ESG investments, meaning that they're taking retirement funds and they're turning around and they're not giving you the best yield from them. They're just using it for their own social agenda. And I saw that Governor DeSantis said, F you, we're done with that crap. He pulled $2 billion out of Florida and said, we're not doing this. I think we're going to start seeing states do this, because they're not looking at what's best for the end user. They're looking at what they feel is their own social agenda. Now, here in California, we have, the party in power has just been a complete nightmare. They don't care about your money. They overtax you. They don't care if your money's being used for anything except for their agenda. That's always how it's been for the last 5-10 years, and it's going to continue. But I see other states starting to feel the same way. If you're not looking out what's best for a government entity or the state, if you're not looking what's best for its residents, then why should you or anybody else be investing into them? And this is important to see. I'm thinking there's a turning point here that we're going to start seeing this. I know, and we can, before I jump into the rates, I know that over the weekend, we saw a huge shift in where news outlets are going and what's happening. We know that there's all this, the fluff pieces on Sam Bankman-Fried and the FTX saga. We're seeing that, in the New York Times and the Washington Post and in Reuters, they're all like, oh, poor kid. He does the whole tour, the apologetic tour. He committed fraud, guys. It's not up for debate. The new CEO of FTX said there was more fraud here than Enron. And the issue is that local House of Representatives right in Los Angeles is the head of the financial committee. And I think that we're now seeing that on Twitter that she's being called out heavily and that the truths are starting to come out. I don't want to talk about the whole, president's son's, computer, if I want to call it, and all those files that came out. But we're starting to see that this social agenda that's being forced on you and the lies that are happening out there are now coming to the top, and people are seeing it. And because of that, you're either going to do what's best for the people, or let's stop doing anything, or again, taking back what these companies are doing for you. Self-directed IRAs, not financial advice, but that's where I'd be looking into. Last article here, we're continually seeing that conforming as well as FHA keep going down. I predicted last Thursday that we would be under 6.5. Look where we're at, 6.36. We saw another drop. Look at FHA, 6.315. It's going to be very interesting what's going to happen next week with the Fed meets. That looks like a 50 basis point raise. I absolutely think that all these mortgage companies are already pivoting, thinking that the Fed's going to pivot somewhere in the near future. But I still think that the Fed has probably another 6 months worth of raising here. We're going to see if they continue to think that they're going to pivot, they're going to float down. I still say that we'll be closing in on 6, hopefully by the end of the year. If that's a fact, guys, this is the best time in the fourth quarter to buy. We have these rates down. I'm talking to a lot of my clients about it. I'm hoping that, we're seeing that these things will happen. If the Fed pivots, they're pivoting because they've destroyed enough jobs. And they're destroying enough jobs, meaning that jobs that are utilized for mortgage payments, not jobs, again, that are for, minimum wage. Minimum wage isn't buying a house today. Right? Unless they're buying it, they're in a combination, they're buying it with somebody that's making good money. They said that the medium home price today, you'd have to make about $107,000 combined household income. I say that's BS because you can get loans out there that are ARMs as long as you can qualify for the full payment. So guys, thank you very much for joining us today. My name is Troy. If you like what we're hitting, hit that like button, boom, boom. Otherwise, leave a comment below. I'm more than happy to answer them for you. I see this as a very big positive as we keep going forward. 2023 is going to be very interesting. You guys take care. We will see you tomorrow.